Okay, I'm going to start out. Ciao, everyone. I'm Peggy West. I'm the organizer of the Condo Zone webinars here. Happy to offer this course this morning on reserves. Reserves. Okay, we've heard a lot of courses about it. It's complicated, right, today, and let's hope that you will leave this webinar with a better understanding of reserves and what you as a manager and you as a board member really need to know to stay in compliance for your community. So first I want to thank Sundeep and my moderator today, Daniel Baum, for moderating and everyone coming to the class today. I especially want to take a minute and thank our veterans out there because all of you have served and are serving, are very much appreciated by America, and we celebrate you and just want you to know you are appreciated. So happy holidays, and let's get into it here. First, I want to do some housekeeping. Housekeeping starts with CAM credits, okay? I'm a CAM myself. Near and dear to my heart is getting those credits posted, which Sundeep's team will do. And just give them about 2 weeks to get it all done. We have over 340 registered guests today. Put your questions into the Q&A today, please. Q&A, not the chat box. We record Q&A, and today all of the questions are going to be held until the end. Sundeep is going to do his presentation, and if he doesn't get to answer everything, he will answer it in a private email. And if it's a big question, he's going to send it to me, and I'll distribute it out to everyone with his answer. So just so everyone knows, you board members, this is not a required class for board members to get a credit. The only required class that you have to take is the legal update. Every year you have to take the legal update. So I have a legal update class I'm going to announce at the end of this presentation. So with that, I want to welcome our sponsors for today. These are the ones that invited you, who appreciate your business. They have a vested interest in you. And I'm going to start right off the bat with my wind beneath my wings with Vinteum software. Today we had Laura on. Laura, tell us about yourself and what are you doing for associations?
Thank you, Peggy. Hi, everyone. My name is Laura. I'm a sales executive here at Vinteum. We're a company that specializes in providing services and software for HOAs, condominiums, cooperatives, and we also work with property management companies as well, with property managers. What we do is that, as most of you already know, especially in the state of Florida, associations nowadays will require to have residence portal, a website, a place where they can storage safely their documents, and especially somewhere where communication actually works with residents, where you keep your community engaged, and we provide all of that to you guys. We build a website for you. We set up the residence portal for all of you guys. We help you making sure that everything is organized and everything complies to the Florida law nowadays. So yeah, that's basically what we specialize on. And just as a little reminder, we're also right now running on our Black November promotion. So we're already half November in. So if any of you guys is looking to, have a website or a portal, it has not really made those changes yet. This is your time to partner with us, get the discount, save a little bit of your budget. And also, if you're a property manager or if you work at a property management company, you can also get in touch with us to see the special pricing structure that we have for you guys. So we will send you our information on the chat. So if you have any questions or if you want to get in touch with us, you can reach out to that contact that we will send you. Thank you.
Awesome. Okay, great. They also do electronic voting if anyone is interested in taking a stab at that. And I just want to recommend them from the standpoint of uh, going into the computer era. As a baby boomer myself, I just want to say that, it's easy. It's so easy. And Vinteum makes it so easy. They will actually give you a private one-on-one demonstration. And if you go with them, they will help you from start to finish. And you can call them a million times at no charge. Did I say that?
Yes.
Okay.
You're absolutely right. Thank you very
As
much,
much as
Peggy.
much as needed. Okay. All right. Number two, I have Daniel Baum, our moderator for today. He is the owner and founder of COA Solutions, a very reputable South Florida insurance broker. And I want to recommend him also. Tell us what you're doing, Daniel, and about your company.
Thanks, Peggy. Hi, everyone. My name is Daniel Baum. I am the CEO and founder of COA Solutions of Florida. I like to say that my job is to help you find the least expensive insurance at the best and finding the best coverage. So, how do I help you save money? The key is always making sure we not only check all markets for available options, but also make sure we have the right paperwork. I can't tell you how many times I find errors in paperwork, and those errors cost you tens of thousands of dollars in premium. So I always recommend to my customers, make sure we review your documents, make sure you have everything correctly filed, and you're getting the credits that you should get. It's been a terrific season. Thank God for all of us. It's been a quiet hurricane season, which means premiums should be going down on the property side. That's another great year for us. If you're not seeing premiums go down, maybe you're not with the right carrier. Maybe you need to explore more markets. But that's what you should be seeing out there. And hopefully, we're going to just continue to see that going into the year end, into Q1. December, huge month for renewals. December 31 is a major date for renewals for communities to renew their insurance. If anyone is concerned that you're not getting a good set of eyes on your policies, or that you don't have competing bids, or you just want me to take a look and give you my opinion, I do a complimentary review of your policies. There's nothing to sign. I'm happy to give you my opinion and let me know if I can do anything for you or if you're in good hands. Thank you very much again for having me today. I look forward to moderating the webinar, and back to you, Peggy.
Okay, thank you so much. All right, next I want to introduce Siobhan Gonzalez. She's with United Professional Engineering and one of the best engineering firms, I feel, in the whole state of Florida. So tell us why, Siobhan.
Oh, Peggy, thank you so much. Yes, it is a privilege and an honor to represent United Professional Engineering, and our president and owner, Carmelo Giglio, is a trusted leader and authority in the industry. You know, he is two-time elected president of the Florida Structural Engineers Association, the FSEA. He has roots, and he was a part of Surfside Working Group, helping to write the new legislation to prevent tragedies like that from happening in the future. So I share that to say is that we have a huge emphasis at our firm on educating and empowering managers and boards to make the best decision. There's a lot of misinformation out there. There's a lot of information and a lot of questions. So we're here to help. I will put my direct cell phone number in the chat, and you'll get it on the sponsor sheet. But if you have any questions around engineering issues going on at your association, we are offering you a complimentary consultation. We've been serving South Florida and condominiums for over 20 years. So this is what we do. Our firm is trained, experienced, accredited, licensed to serve you and your associations and be that resource for you. From all things special inspections, milestones, phase 1, phase 2, recertification, concrete restoration and repair, painting, roofing, pool decks, all the things. We're here to serve you. Set apart, we are with you every step of the way. Part of our engineering services is we offer deep construction administration services. So it's very extensive. With that, you don't need a project manager with us because we serve as that for you. So if you have any questions, we're here to help. Enjoy the webinar. I'm excited for this one today. And yeah, thank you so much, Peggy.
Thank you. All right. Next, I'm going to introduce the people that are on today. Let's go with Dylan Pena. He is the representative, the owner's son, actually, for PD Concrete. Daniel, and I want to mention Daniel, if you'll let him know I did mention him because he has been in business for 21 years, just celebrated on LinkedIn. So congratulations for that. Dylan, what are you guys doing in particular these days?
Thank you very much, Peggy. Good morning, everybody. Happy Friday. My name is Dylan. I'm the business developer for PD Concrete Specialists. We've been in business for 21 years now. and we're proud to be a trusted name in structural restoration. Now, we specialize in concrete restoration, waterproofing, post-tension cable repair. We also assist with the 40, 50, 60-year recertification process to ensure that your property remains compliant and safe. Now, one thing that sets us apart is that we do not use subcontractors. We only use our in-house team for all of our work. This is to ensure quality work and accountability for every step of the way. We have 2 offices, one in West Palm Beach and one in Aventura. If you have any questions, I'll leave my information in the chat box below. Have a happy weekend, everyone. Thank you very much, Peggy.
You're certainly welcome. Thank you so much. All right, next I want to introduce a relatively new sponsor for my webinars, but not new to the business. They have over 100 service trucks in operation. Let me introduce to you Ruthie and Dahl. Ruthie is the marketing rep for Kaiser Air Conditioning, is specializing also in the condominium industry. Tell us about yourself and what you're doing.
Hi, everyone. Thank you always, Peggy, for all that you're doing consistently for us to get connected. I'm Ruthie. I'm the Director of Marketing here at Kaiser Air Conditioning, and we are locally owned and operated. We are not owned by private equity. So the ownership is local, operations is local, and we believe that local ownership does equal local accountability. So all of your feedback and experiences matter to us. For 20 years, we've served Broward, Palm Beach, Martin, and St. Lucie counties, and we do have experience working with property managers. If you have a resident on your property that needs a recommendation and you send them our way, we're happy to provide you an incentive for that referral. So please contact me directly in those cases so that I can make sure that those referrals get priority and oversee that whole process personally. If you are in a condominium, especially with seasonal residents coming in, also, we're here for you as those seasonal residents are coming in, making sure that their units have the annual maintenance and that they're working properly throughout their time here to make their experience more comfortable while they're in town is obviously going to be important and will make your experience with them for that season much better as well. And for units on the roof, we're able to service those larger individual commercial units, and we can develop a custom plan for you to make sure those are maintained and meet budget every year. So we're open every day with the holidays coming. That's important for me to emphasize. We are open every single day. So if you need anything, we have those resources and I'm your main point of contact. So I'm going to share that information in the chat and please don't hesitate to reach out if you need anything. And I hope you all enjoy the webinar. Thank you so much, Peggy and everyone.
You're welcome. Absolutely. All right. Next, I want to introduce the senior business developer. Been with the company coming up on about 10 years now. We have Diana Alert, Best Roofing. Tell us about yourself. Excuse me.
Good morning, everyone. Thank you so much, Peggy. Thank you, everyone, for being here today. So yeah, I am with Best Roofing. Best Roofing has been a company that has been in business for 47 years now. I've been with them for 6, and we do cover Florida. So if you need absolutely anything, whatever you need on your roof, even if it's a question, a maintenance program, recovery, re-roof, repair, we go from little projects to big ones. So we do single family homes, we do industrial high rises, absolutely everything, basically. We are a renowned company in Florida, and we have our 400 employees. So we'll be more than happy to serve you, help you, and answer any of your questions. So if you need anything from me, please contact me. I'm going to leave the information on the chat box, and enjoy your class today. Thank you very much.
Thank you very much, very much. And thank you for all you do. They're very involved in charities and the industry as well. So coming into the holidays. Next, I want to introduce Dahlia Anise. She is with Legacy Life Plan. She's a specialized attorney. You have to hear all about this, Dahlia.
Hey, thank you, Peggy. Hello, everyone. My name is Dalia Anise. I'm an estate planning attorney with Legacy Life Plan. So what I really do is I help keep families out of court and out of conflict. I do wills, trusts, and capacity planning. I also do wealth preservation planning. And when you look at the statistics, 70% of inherited money is gone once our kids get it, and 90% of it is gone when the grandchildren receive it. That's a staggering number. So what people don't realize is that you can create a wealth preservation estate plan to make sure that your money, your hard-earned money, right, takes a long time to acquire the money, is preserved from generation to generation. So I represent clients all over Florida. If you do have an estate plan already done, I'll be happy to review it with you to see if it does work for you and your family. I'm very the plans really need to, there's no one size fits all. It really depends on your family dynamics. So I will put my information in the chat. I will also put a link for you to schedule a discovery call with me to see if I can be of service to you and your family. Again, enjoy the webinar today, everyone.
Thank you so much. All right. I'm going to mention the following sponsors that are not actually on today. It's Friday and a lot of them had appointments scheduled. But let's start with Faster.io. That is a relatively new streaming service in South Florida. Bob Aleka is your contact for that. He will be onto the sponsor sheet. Now, Faster.io has been around for 30 years. So have an appointment with Bob and he's going to change your mind about how you're getting your cable and your streaming changed. Next, I want to mention First Citizens Bank. We have Jamie Gelfand. She is a senior vice president for First Citizens, helping you with loans. We're coming into the end of the year. Your budgets are being finalized. Your projects are being finalized. Look at your assets, look at what you have, and let Jamie break it down for you as to the best way to handle your financing. Then I want to mention Munyon. Munyon is a painting contractor, and they're also doing a little bit of restoration all over the state of Florida, 75 years in business. They have an East contact and a West Coast contact. I'm going to put both of them on the sponsor sheet for you to reach out to for an appointment. Next, I want to mention a local company to West Palm Beach, Allenac Railings. Allenac has been around also for over 20 years. This is a railing manufacturing company. They also do repairs, and they can do the electrostatic painting with repairs as well. Next, I want to mention Hafer Company. They have 4 offices around the state. This is a auditing firm, CPA firm. Nicole Johnson is the key contact there. Everybody loves Nicole. She will break it down in just layman's terms and keep you in compliance. I think that's very important to know. So if you need another set of eyes for your auditing, please reach out to her off the sponsor sheet. Next, I want to mention the paving lady. This girl travels all over the state. She's like trying to catch a butterfly. They are so busy and they are so reputable. If they weren't reputable, they would not be busy. So if you need help with your paving needs, please reach out to Dawn Miller. She'll be on that list as well. Next, we have City Quiet Windows and Doors. City Quiet is very entrenched in the state of Florida, also with, I believe, 4 offices now. Ben Friedman is the president and the contact directly for an appointment. And then I want to mention Velocity Services Group. Velocity is a large loss restoration company based out of Texas. However, they have a new office in the Tampa area and soon to have one over here in the West Palm Beach area. So Velocity Services Group, they were very instrumental in helping quite a few people on the West Coast when the hurricanes hit so bad last year. And they're still, I'm sure, working on some of that for projects. I wanted to also mention my new website that I have. It's a directory called Florida Condo Vendors with the number 4u.com. Florida Condo Vendors 4u.com. I'm trying to connect my sponsors and vendors with new opportunities for board members and managers to take a look at some new vendors for pricing, because now the law, different from reserves, but the new law says you have to take 3 bids. So with that said, I'm going to turn this over to our moderator again, Daniel Baum. He is going to do the introduction for our speaker for today. Thank you, gentlemen, and good luck.
All right, thanks, Peggy. Okay, just a little bit more, just a reminder of the housekeeping that Peggy mentioned. Please put your questions in the Q&A box. We will not be monitoring the chat. Sundeep will take all of the questions he can at the end of his presentation, and whatever he doesn't get to answer live, he'll look to answer when he sends out copies of the presentation. Ladies and gentlemen, please welcome Sundeep J. He is the Senior Reserve Specialist and Professional Reserve Analyst with J.R. Frazer. Sundeep helps community associations and building owners plan long-term capital projects with clear, defensible reserve studies and funding strategies. Known for translating complex life cycle data into practical, board-ready action, Sundeep brings a calm and analytical approach to decision-making under budget pressure. Today, he'll share a pragmatic insights you can all apply at your next reserve update. So please join me in welcoming Sundeep J.
Hi, everyone. Thank you so much for that introduction, Daniel. I am going to share my screen so we can get the presentation going. There, okay. All right. So basically, I have been myself with my company for about 9 years. So I have a lot of experience. I do about 3 reserve studies a week. So there's just a lot of experience that comes with doing that many reserve studies over the last 9 years. But to be certified as a reserve specialist, you have to work under another reserve specialist for a period of 3 years, which I didn't understand at the beginning, but I absolutely understand why that experience was extremely invaluable. So here we are. So our purpose and overview of the course that we're going to be teaching, or I'm going to be teaching today, is basically learning the difference between an operating account and a reserve account. And it's also to identify some of the important categories that are involved in a reserve study. And then the other part is understanding some of the terminology. So even when I first got into this business with an accounting background, I was still confused with the terminology that they were using. And then I'm going to talk a little bit about the legal requirements and just clarifying some of the rules that revolve around reserve studies. Okay. Okay. Now, as all of you guys are aware, there are 2 sets of books that associations should keep. One is for the operating side, and the other is for the reserves. The operating is things that are more annual in nature. So it's things such as your management fees, your landscaping and irrigation, your pool maintenance, your utilities like your electric bill, water bill, maybe internet and things like that, office supplies, maintenance fees, or management dues and things like that. So these are things that happen every year, day in and day out. That is what belongs on the operating side. Everything that is asset related and long-term belong on the reserve study side. So things such as that may be roof replacements, painting of the buildings, paving, elevator modernization. You may have a generator, concrete restoration, and things like that. Most items in a reserve study are out for a period of at least 5, 10, 20 plus years. So just remember that that's what the reserves are about. Now, I'm going to add one more important aspect of this. When we prepare a reserve study, or when you get a reserve study, there are 3 different aspects to it. One is, of course, you have the state laws that we must follow. Second is there are reserve study standards, national reserve study standards that we need to also follow and abide by. And thirdly, it's accounting principles. and they don't always work together. But we try to do the best we can. And sometimes, in my personal opinion, the state law is sort of the bare minimum. So in reserve studies, and if you get a good one, it should encompass all three of them and not just the basic laws that are here in the state of Florida. So just remember that. Now, it's not that you can't pay for certain things that are reserve related out of operating, but the concept and the asset itself should belong on the reserve study side because it is an asset. And the more you get into the practice of doing it this way, the better your books are going to look. Otherwise, if you're taking care of your assets on your operating side, well, you're not really getting a true picture on your reserve side of what is happening there over 3, 4, 5, 10, 15 years. So that's another reason why these two accounts should be kept separate. And if there are old habits where things were paid out of operating, then it really should be changed over to the reserves. If anything, your operating ongoing expense should go down because now you're collecting it from the reserve study side. Okay. Okay. Why reserves matters. So let's start at the top. It promotes fairness amongst owners. It ensures that all current owners pay their fair share of the asset depreciation, and it prevents passing the buck to future homeowners or unit owners. Remember, you are paying into reserves for today's depreciation every single day, whether it's the rain beating on your roof or the 100-degree temperature that's also beating up on your roof, or the vendors driving on your asphalt or your pavers, and or the elevator going up and down in your building. This is depreciation that is happening daily, and thousands of dollars are leaving your association, and the people or the unit owners that are living there are responsible to take care of that depreciation. So I do want to make sure everybody understands that there is a mindset where the thought process is that why am I paying for something 5, 10, 15 years into the future? Really, if you look at your condo docs or even your HOA docs, there's nothing that guarantees you a brand new roof or a new playground or a new swimming pool or anything to that effect. So you're literally paying for it for its use, for its depreciation. And that's why all of the laws and even reserve study standards are based on replenishing that depreciation. So that is why you are paying into reserves. And one more comment that I like to make on top of that is that, and it's just things that I hear. It's my money. I can earn more interest. Why should I give it to the association? But out of all fairness to it, at the end of today, it's not really your money anymore. It's an IOU to the association. It's just collected once a month or biannually or quarterly. So remember, the money is really not yours to invest because the depreciation has taken place. The association owns that money. They can invest it in a safe place, but it's no longer your money. So I just wanted to put that out there because some of these laws don't give you that luxury anymore, basically. Okay. Second, it reduces the risk of special assessment. So adequate reserves helps avoid last-minute emergency funding and also reduces financial stress and conflict within the community. So remember, a reserve study reduces the risk of special assessments. It doesn't promise you that a special assessment will not occur. And there are many, many, many reasons why. One is that you may have not been properly funded in the first place. Secondly, it could be inflation and the numbers were not updated. Thirdly, code changes. All of a sudden, you're trying to replace a fire pump. It costs $50,000, $60,000. The city comes in, and now it's another $40,000, $50,000. And that's a real example. And also upgrades. There could be upgrades to things. So these are many different reasons why a special assessment can still be possible because you're using more money out of reserves than we had budgeted within the reserve study. So but the real fact is it still reduces the risk of a special assessment, along with allowing people to see the true cost of living in a condominium or even an HOA. There's a real cost of living there. And by keeping these dues low, it doesn't help that perception. So the better you collect your reserves, the better the understanding is even to potential buyers wanting to buy somewhere to know what the real cost is before they move in. Okay. It supports long-term community planning. It helps boards and managers make informed maintenance decisions. It aligns with professional management and fiduciary responsibility. Now, I'm going to go to the first one, and I would hear this quite often as well. Well, I don't want board members to misuse my money. Now, property managers might give you a different response, but I do collect contracts. And I can assure you that more times than not, I see board members not spending the money when the money needs to be spent. Instead, something is being repaired when something should be replaced. So remember, the more money you have in reserves, the right decisions can be made, and you can actually clean your hands and not worry about anything for the next 15, 20, even 35 years if it's something like a fire pump or a domestic water station. But if you keep putting a Band-Aid on it, you're going to constantly have to deal with something. And again, when you are reserving, it's different than if you are reserving for your own home or even your own business, because the board has a fiduciary responsibility. And as everybody knows, the board members are working for free. Their stress is to make sure everything is running smoothly. Things are looking beautiful, which is just as important as the safety, and it requires money in order to do that. Okay. And of course, the last, which is probably on top of all of this, but it's still at the bottom, it complies with Florida law. So it is the law that you must be putting monies aside for reserves. So just don't forget that. It is the law. You are required to do so. Okay. Okay. Typical reserve components. So what kind of things would you find in your reserve study? Okay. Your roofing systems. And so there's so many different kinds, from flat roofs to shingle roofs to tile roofs, metal roofs, so on. You have painting, and it's all kinds of painting: garage, exterior, interior, your light poles. All of these are important. Pavement surfaces. So it's all of your pavement. It's just not your asphalt. It's just not your pavers. You have sidewalks, you have curbs. You may have at your entryway travertine tiles. Those are all under the pavement resurfacing classification. Then you have your pool systems, elevators, irrigation systems, and these are just to name a few. Of course, there are a lot more depending on the size of your community, but these are the ones that you see most often, more than not. Okay. And reserve items are generally include major shared assets that are long-term in lifespan and require significant funding for their repairs, replacements, restorations, and upgrades. They have a useful life of anywhere between 5 to 50 years. Doesn't mean it can't have a useful life of 2 years or 3 years. So there are things that are 2, 3 years in nature. And again, it's an asset, hence they belong in a reserve study. Okay, these are things that you may or may not see in detail, but all of these things should be located on your reserve study. Now, remember what I had mentioned previously. When these things are put together, there are accounting principles and there are reserve study standards. So even our state of Florida, though they may have not listed them specifically, it doesn't mean they do not belong in a reserve study. Okay. All right, now there are two forms of accounting methods for doing your pooled reserves and or straight line reserves. So there are two ways of the accounting method. The first is your pooled reserves, which is on the left side of my screen. So I'm just going to literally read what it says first. All reserve contributions go into a single pool of funds. So after all the math is done, everything gets put into one big pot. Now, the benefit. It allows flexibility, and any reserve expenditure can be paid from the pool as long as future funding meets projected needs. Secondly, or thirdly, simplifies budgeting and reduces need for line item deficits. And SERS and traditional reserve balances and contributions must be kept separate at all times. So I do want to signify that, because even this past year, there was some confusion that someone had heard that pooled reserves are not required or cannot be applied under the new law, and that is not the case. So pooled reserves is allowed on your SERS report. It's also allowed on your non-SERS, or what we're calling it, the traditional reserves. You have to keep them separate. You can pool it on the SERS side and the non-SERS side. You just can't interchange those monies together. So actually starting this year, but officially I think a lot of associations are going to start January 1st of 2026. So just remember that if you do or required to have a SERS, you need to now have two separate accounts on your balance sheet. And you also need to show that on your operating side of what you are collecting in reserves. Now, if you are not required to have SERS, then you're just going to have one line item. So those are the things related to pooled reserves. If you were doing them, the biggest point is that once all the math is done, all of it gets put into one big account, and then you can spend for any of those items. So for example, on the SERS, if you were short on your roofing project and you had, another 50 or 100 or 300,000 sitting elsewhere within that reserve study, you can actually use that money to finish off that project versus special assessing. Now, to the right side, it's the component/straight line method. So again, I'm going to read it off to you. It's a specific asset with a defined cost, useful life, and replacement schedule. Each reserve category has its own reserve section, funding target, and balance. It's easier to track. Exact account balances of each asset can be seen quite easily, but there is less flexibility and cannot shift funds between categories without a membership vote. So one of the things that you need to understand, which I'm going to actually explain a little bit later, is on the straight line method. If you have money set aside for your roofing system, that money has to stay there. You cannot give it to another category without a vote from the membership. So that is the biggest thing about the straight line method. There are pros and cons to both methods. Firstly, the biggest pro to the pool of funds is that if you have deficit funding, and most condominiums and a lot of associations, HOAs, have something called deficit funding. Deficit funding is you do not have enough monies in reserves and projects are coming up, so we now need to collect more than your normal annual contribution. So when you use the pooled reserves and you're sharing all of the funds, the contribution goes down. So I'm going to say that's probably the primary reason why most people switch to the pool of funds method. And then secondly, of course, as I had mentioned earlier, if you were $50,000 short, let's say on a roofing project, if you don't have it on your operating, your only option is to special assess, where in the pool, the money's there, you can go ahead and use it to finish off the project. Where in the straight line method, you are restricted. So if you are short in the roofing, for example, again, you can go out, which is still work, right? You still have to go out and do the work to get the vote, to get monies from one account to the other. And secondly, maybe you might have it in your operating account. And of course, otherwise, it's going to be a special assessment. So that is sort of the drawbacks of having the straight line method. It is a very good method because at any given point, so it has its pros as well, you will know that I am a $500,000 short on my painting project or roofing project or elevator project. You will be able to see it immediately where it's not relevant in your pooled reserves. Now, in your pooled reserves, because everything is pooled, I would recommend getting updates sooner than later from your reserve provider because there is a tendency to overspend. Overspend because of no other reason than there are surprises that happen in a condominium, for example. So those things happen. Projects with inflation and tariffs and things like that. You might have budgeted 100,000 and now it's costing you 150,000. You just go into reserves and take the money to use it. But when you take 50,000 out of your pooled reserves, you are taking monies away from other projects that we have budgeted for. So if you do use the pooled reserves, you do want to get updates more often than if you were using the straight line method. Okay. Basic terminology, replacement cost. It's basically the estimated cost to replace a component at today's pricing, may be derived from cost manuals, contractor proposals, or prior association expenses. I'm going to tell you exactly where replacement cost comes from most reserve studies. One of them is from the association itself. Secondly, it comes from associations such as yourself who have also provided these contracts to the reserve provider that you're probably using. So that's how most reserve companies typically do work. They do not call three contractors because three contractors will not call them back, let alone one contractor when they're not getting the business. So there is this notion that, hey, go out and get three proposals. No, it doesn't work that way. But a good way of handling the replacement cost, if you are concerned, is before ordering a reserve study, call your vendors. Get these estimates so your reserve provider can use that on your reserve study. But that is what a replacement cost is. It is today's cost of either repairing or replacing something. The useful life. It is the total period of an asset of how long it is expected to continue performing its own function or how long it lasts. For example, most flat roofing systems last 20 years. Elevators, they have a range, but it's anywhere from 25 to 30 years. So everything has a useful life. Most times the useful life is an industry used number, but your reserve provider does have the ability to adjust that number. So for example, if you have an outside AC unit and you're located on the ocean, they're not going to give you the same useful life as something you might have, a property that may be 10, 15 miles inland. But that's what a useful life is. And the remaining life is exactly that. How long is it before you need to either do a repair on this particular asset and or to replace that asset? Okay. One thing really quickly. We need remaining lives on the reserve study for no other reasons than the math doesn't come out if we don't have the remaining life. So the math has to come out, hence we have to have a remaining life. It is the reserve study standards. But the thing is, in the state of Florida, and I'm going to probably say throughout the country, the board is not necessarily bound by the remaining life. So for example, let's say a pool pump that costs whatever, $1,500 or $2,000, and it has a 10-year or 8-year useful life. And let's say the remaining life is 3 years. Well, that doesn't mean that you have to replace that pool pump in 3 years. You may replace it in 1 year if there's a lightning strike nearby or it just malfunctions and breaks. But at the same time, it may function for 2 or 3 more years. It's a possibility. It depends on where the motor was made. So the remaining life can adjust, and board members are not held to the remaining life. But we do urge board members to use the remaining life as a roadmap. See where you are. I mean, if you see something that had a remaining life of 1 of 2 years, investigate it. See, is it really in bad condition? I know it's at the end of its useful life, especially before you put good money after that particular asset, because you might find yourself a couple of years later, after spending $15,000, that, my God, I have to spend $80,000 anyways today. So it's really important to at least look at the remaining lives. They can and they will vary on every reserve study. Normal annual contribution. That's the next thing, top right-hand corner. I'll just give you a basic math. It's a $100,000 roof. I use this example all the time. It lasts 20 years. Simple math. Take 100,000, divide it into 20 years. You're going to get $5,000 a year. That is what a normal annual contribution is. Every asset that you own has something called a normal annual contribution, whether it's your light poles or your elevator and or your roof or your interiors or the carpeting in the lobby or tiles in the lobby. Everything has a cost. Everything has a useful life. So it's basically taking the cost, dividing it by the useful life, and that's how you get the normal annual contribution. Now, fully funded balance. It's usually at a particular point in time. So I'm going to read that and I'm going to give you a different wordage on it. So the fully funded balance that you see on a reserve study is the ideal amount that should be in reserves if contributions had been made consistently since installation or last repair or restoration to that particular item. The formula is pretty easy. It's your normal contribution times the useful life minus the remaining life. So the word that I like to use, or a definition that I want to provide, is fully funded balance. In a perfect world that I don't really believe as a reserve specialist exists, how much money should you have had in reserves as of the date your report was completed? That is what a fully funded balance is. Okay. And the percentage funded is what we look at, or what it actually is that we take what you actually have in reserves and divide it by the fully funded balance. That's the simple math. What do you actually have in reserves versus what you should have had in reserves as of the date the report was completed, and it will give you a percentage. I will give you a statistic that was given to me by an association about 2-3 years ago, about 3 years ago, I think. Average in the state of Florida was 0 to 35%. That was the average. I believe to some extent, some of that might be true today. I do believe next year that percentage funded will be changing. So just remember that percentage. So most associations, if they're supposed to have 100,000 in their reserves as of the date of the reserve study, most associations would have had either nothing up to 35% of that money. Okay. Doesn't mean that others didn't have more. It's just that's where the average was. Fully funded annual contributions. So fully funding annual contribution. As I mentioned on the previous page, there is something called the normal annual contribution, where you take a roof for $100,000 and you divide it by 20 years, you get something, called the normal annual contribution, which in that example was about $5,000. So that example is carried forward here. So a fully funding reserve contribution is where the association is setting aside basically the appropriate annual amount of money based on the normal annual contribution plus any deficit funding that may be required. This is the state of Florida requirement for all reserves. So your fully funding annual contribution amount is what the state is requiring. And it can be different if you are not properly funded, which means if you've been collecting the normal annual contribution and it's not sufficient enough, then we have to add something called deficit funding to the reserves. So it is the fully funding annual contribution amount that the state is requiring. So this page is a little important for everybody to understand. So I'm going to get into just a quick example. I use this quite often. So it's the same example. If you had a roof replacement, as you can see at the top side where it says roof replacement cost $100,000, but the useful life is 20 years. That means you're collecting $5,000 a year, which is this. Oh, I can't highlight it. Shoot. Okay. Let me go back. There it is. Okay. So, and then let's say we're in year 10. So in year 10, your fully funded balance is $50,000. How much money should you have had in reserves as of the date of the report? So a $100,000 roof, halfway through its life, the association should have had $50,000 in their bank, but they don't. They only have $20,000 in their bank. And the state of Florida does not require associations to be fully funded. So the state of Florida does not say, well, wait a minute, they have a $30,000 deficit, as you can see here. You don't have to put that in the bank today. Now, this is a very simple example, but associations are 100, a million, 3 million, $4 million. So this deficit amount can be quite large, but the state of Florida is not saying that you need to be fully funded. What they want associations to be doing is to be fully funding their reserves on an annual basis. So this $30,000 shortfall that's not in your reserves today, and we have 10 more years left. Basically, we take 30,000 divided by the 10 years, which is another $3,000 a year. That is what we call deficit funding. So now what you're going to do to come up with your fully funding annual contribution amount is take the 5,000 normal contribution, add the deficit funding. You're now going to collect $8,000 a year. That is going to be your fully funding state required annual contribution amount for the next 10 years. Okay, it's no longer the straight component method where you're only collecting 5,000. You have to play catch up. The purpose behind these laws are when you are at the end of their useful life of a certain asset, the board has the money to make the right decision. If something requires replacement, it should be done. If something can wait a couple of years, then you wait. but the concept is to get the monies in place by that time. And that is what is achieved by the fully funding annual contribution amount. Florida statute requirements. Okay, here are the laws. So number one, it's roofing, painting, paving, and anything that equals to $25,000 or more. So I am going to talk to you about this $25,000 or more. Now, if you've heard 10,000, you would be right, but except July 1st of this year, that law changed. It is $25,000 or more. And these are the basic categories for all condominiums to follow. And there has been some debate on this $25,000, so I do want to elaborate a little bit. Remember, the $25,000 is a minimum state requirement. There is still something called reserve study standards, and there's still something called accounting standards. They don't care about this $25,000. You have a $10,000, $15,000 asset that's on your books that needs to be in a reserve study. That is how it's supposed to be if you want to do reserving properly. Otherwise, you are going to be short somewhere. You are not accounting for all of your assets because most people, for example, are not going to be putting aside $15,000 or budgeting for these assets on the operating side, nor should the association be doing that on the operating side. Annual things happen there. That is accounting standards. So you may have things on your reserve study less than $25,000 because that's where it belongs. Keep in mind, following accounting standards, following reserve study standards, these things belong in a reserve study. But for law purposes, it's roofing, painting, paving, and anything that equals to $25,000 or more. One more thing. $25,000 can be one item or a system. And I always use pool equipment as a system. If you remove one motor, you don't have a system anymore and your pool stops functioning. So it's a system along with it can also be one item. Okay. Number two, threshold change. The previous 10,000 threshold has been, oh, well, I already discussed that, increased to 25,000. So that threshold of that $25,000, it used to be 10,000, but as of July 1st, it is $25,000 or more. Budget inclusions, which is number three. Required reserve categories and contributions must be included in your annual budget. And the applicability applies to condominiums and cooperatives. HOA communities are statutory versus non-statutory reserves that you would need to find out by reading your own docs and or talking to your attorney. But even with HOA communities, remember, an asset is still an asset. The replacement cost is still a replacement cost. Everything has a useful life. So even though HOAs may not have laws on their books, it doesn't mean you do not need to follow the exact concept that is followed by a condominium building. Okay? Just because the laws aren't there doesn't mean you don't need to be doing this as an association. It is the fiduciary responsibility and it is the responsible thing to do proper reserving even for HOA communities. Just because I have to urge this, you don't need the law to tell you to do the right thing. You know what the right thing is. So this is the purpose of reserves. This is the purpose of this class 101. There's a reason behind these reserves. The first thing is it makes it fair for the human beings that are living there and the new human beings which will eventually come and move there, potentially buy your unit or your home. And it needs to stay fair to everyone for the life of that association, not for the life of that individual. Okay? And please, I have a little note at the bottom. Please pay attention to statutory changes. They seem to be changing them every year for the last 3 years. So pay attention to that and also pay attention to inflation. Most reserve studies are created based on today's cost. That means every year you should be adding inflation to the annual contribution amount. It's wise to do so. Let's put it that way. Understanding waivers and flexibilities. Okay, so associations could waive or reduce reserves contributions with a majority vote of a quorum of a unit owner at a duly noticed membership meeting. This applies to all reserve categories, including what are now considered SERS items. That is not the case anymore for condominiums. Okay, so I'm going to go ahead and read some of the things that I have on my chart. Changes under the SB 154 and SB 4D. SERS, which is, by the way, it's Structural Integrity Reserve Study. If you've heard the word SERS or SEERS, it's the same thing pronounced differently. So waiver of reserves are no longer permitted for budgets that were adopted after December 31st, 2024. So if you have the SERS report, you are not allowed to waive it. Let's just talk about next year, starting January 1st of 2026. Whatever the number is on your reserve study for your SERS, you must be annually fully funding that amount. There is no longer options to partially fund those reserves. Applies, and again, it applies to buildings that are 3 habitable stories or taller in height. Okay. The word habitable was added this year. So there was some confusion as to if it's on stilts or if there's a parking garage on the bottom, do we still need a structural integrity reserve study? Now it's basically saying it's habitable. So you need to have some kind of a living space on all 3 of those floors in order to classify, in order to need a SERS report. I am going to talk about an exception to this rule. But please, I would urge you to speak with your attorney before completely listening to what I'm saying, because I am sort of interpreting the law here. If you have ordered the milestone inspection, and that milestone inspection requires repairs. So during the span of those repairs, up to a period of 2 years, the board can choose to pause the funding of their reserves, specifically the Structural Integrity Reserve Study. That law came out this year. The board still needs a majority vote of the membership in order to pause the funding of the SERS report for either it's 1 or 2 years. But it is based on maybe the engineering or the milestone inspection, and if there are repairs related to that. But please speak with your attorney to get further clarification. That is the only exception to the rule that I'm aware about. There is something also related to a line of credit, which I do not want to discuss. It's something else what I'd highly recommend speaking with your attorney about if you have any questions about that. I am not in agreement with the line of credit because it's another form of kicking the can down the road. So I'm not a fan of it. I do not know why the state of Florida came up with it. But if you want more details, I would strongly urge speaking with your attorney. Yeah, it must be kept separate. So just remember, you are going to now have 2 different accounts if you are 3 stories or taller. Now, if you're not 3 stories and you're only 1 story or 2 stories, you're an HOA community, all you need is 1 reserve account. Now, and I'm specifically talking about your balance sheet. I'm not talking about physical bank accounts. That is not a part of the law, so you don't need to have multiple bank accounts. You can't. But on your balance sheet, if you are 1 story, 2 stories, or an HOA, all you need is 1 account listed as a line item on your balance sheet. But if you have or are required to do the SERS, then you're going to have a line item for your SERS, and you are also going to have a line item for your non-SERS. They cannot be commingled. Those monies must be kept separate on your balance sheet. Okay. The other thing that also came out in 2025 is the board no longer requires a majority vote of the membership to switch from the pooling method over to the straight line method. So that's something also really new. I mean, it's not really new. It's been around all along. You're allowed to do it, but there's rules behind it. But they have actually wrote this in the law or the statutes. So just so everybody knows that if you're looking to switch over, you no longer need a board vote. I'm sorry, you no longer need a majority vote of the membership. And as I had mentioned earlier, you can pool your SERS and you can pool your non-SERS or your traditional. You just can't mix them together. They have to be kept separate. Okay. Your non-CERs, which is number 2 below, they are still eligible for waiver. So you can still partially fund your non-CERs or your traditional reserves, except the board now needs, excuse me, a majority vote of the membership. So if your reserve study on the non-CERS side stated that you need to contribute $100,000, it is up to the board to put it out to the membership whether they want to partially fund or not. So the board within themselves must agree, okay, we don't want to do 100,000, we want to do 50% or zero or whatever, 70%, but they now have to put that number out to a vote to their membership. If the board does not get a vote, the board does not have an option but to annually fully fund their reserves. So now it's a membership vote when once upon a time it was a quorum vote. So it is much tougher today because most people don't vote, or at least that was the past, where now if they do not vote, the board is not going to have that option. I have been asked in the past, well, isn't that up to the association? The answer is no. It is up to the board to decide whether they want to partially fund their reserves. My recommendation is to be careful. The assets that you own on the non-CERS side or the traditional side are equally important in upholding the value of your association. If you partially fund, of course, you're going to increase your risk of special assessments, but when you update your reserve study, those numbers are going to come right back and they're most likely going to be even higher because these things never go away. So just be cautious. And once again, when you are partially funding reserves, you're basically potentially allowing potential buyers that are coming into your community thinking that it's okay that I can afford to live here at this cost when that real cost may or may not be disclosed to them. So I'm going to go ahead and turn the page. Okay. Now, we have almost reviewed a lot of different things, which is going to give me time to further elaborate on this deficit funding, which was another section prior to. So basically, the things that we had reviewed today is your reserves versus your operating. Remember the difference between the two. And if you are not doing it the way accounting standards are, you may want to move it forward in that direction. Again, speak with your CPA. Planning of your components. It's really, really important. You own these assets. You need to be reserving for those or you are going to have problems. You are going to run out of money and need to special assess. And the whole purpose of a reserve study is to reduce the risk of special assessments. Terminology. So we discussed a lot of different words. Just remember the word fully funding annual contribution amount. That is the amount that is required by the state for you to be annually fully funding your reserves. You are not required to be fully funded. We talked about how we calculated some of these amounts, and of course, we talked about some of these laws. I believe we talked about more of the most important laws that were out there. And then, of course, the different types of funding I can never use that word, methodology that we used in reserves. Now, I do want to, before I close up, I want to show one more thing to everyone, which is also there. Okay. I usually get asked many, many different questions, and we had talked about this earlier in my presentation, the difference between the pooled funds and the restricted funds, and why is there such a big difference? Why is there a difference between the pooled funds and the restricted funds when it comes to annually contributing to reserves? So I prepared this example sheet, and I'm going to go through it fairly quickly because I want to make sure that you guys have enough time to ask questions. So again, here we have roofing, which is one of the categories, and we've done the math on it. Basically, we're looking at $112,000. The normal annual contribution is about $5,329. Then we have painting the same way. It costs $37,000. You're contributing $4,652. And then you have paving, where you have 34,000 contributing $1,561 to the reserves. So here, These things are not going to change on the pooled funds or the restricted funds. So the math that I just showed you on the roofing, painting, paving, that comes up with your normal contribution of 11,542 does not change for either method. This method stays. It looks like the component method, and it is the component method. But this part doesn't change for either of the two pool of funds and or the restricted funds. Here, what I'm about to show you is what are the impacts one versus the other. So in this particular analysis, what I've done is over here, this is what you would want to call the fully funded balance. How much money should the associates have had in the reserves as of the date we did this report? And that was about $127,000. How much did the association have? They had about $30,000 in reserves, which means they have a deficit of $97,000. Now, this is the section that ends up changing between the two methods. So here in the pool of funds, as you can see at the top, we start you out at $30,000. We list out all of your expenses over the next 20 years, which is listed year by year by year. We plug in that thing called the normal annual contribution, right? Again, that number doesn't change for either of the methods. The normal annual contribution stays the same. It's that roofing example, the $5,000 every year, whether it's component method, straight line, and or pool of funds stays the same. That's the 11,542. Now, once we put all these numbers in there, what our goal is to keep you above a certain threshold. This is based on a threshold funding. We want to make sure that this association always has at least 15,000 in their reserves at any given time. So when you look at the last column, you'll see that in year 6, due to this roofing project, there is a deficit of $43,000 in their reserves. So what they have today is just not sufficient to be covered by this annual contribution amount. So what we do, we have to plug in this number called and it's about $58,000 under the deficit amount that I had mentioned earlier. And that brings the balance up to $15,000. But by reserve study standards and also by state law, we are not allowed to leave this number here. That would be called a special assessment. It also gives the reason people living there in year 5 and 6 to move out before they get hit with this $58,000. So what the state of Florida said is this deficit must be taken care of starting today or starting the next budget year. So what we do is we take $58,000, and divide it equally into all the preceding years because everybody living there today is responsible for that deficit. Remember, that deficit that occurred in year 6, it was created from the past of not having enough money in reserves. So the state of Florida and Reserve Study Standards says, well, it's from the past. Everybody living there now, starting today, needs to take care of that deficit moving forward so there's sufficient monies and reserves in the future. So that's what happened here. Now, once we did that, we move on. Wow, it happened again. There's not enough money in reserves. We're back to a negative 1,672. So we now have to add that amount in there again. But we can't keep 16,000 in there. It's called a balloon payment. Not really. It's called a special assessment. But we have to take that number and divide it equally into all of the preceding numbers all the way up into year 1. The way this reserve study is prepared, or all other reserve studies are prepared, is for the fairness to start occurring the first year, because the deficits that have occurred or are or can be produced in the future are from the past. We're just dealing with it in the present. So we can't go from a lower number to a higher number. That is not allowed. We can go from a higher number to a lower number, which is what's happening here. So your fully funding state required number is the adding of these two numbers, which now comes out to this number, which is the 22,886. And that's on the pool of funds method. And twice it happened. Sometimes it can happen 5 times, sometimes it can happen 8 times, sometimes it can happen once. But that is the goal of threshold funding, and that is how deficit funding is applied. As you can see in this example, they were collecting, let's say, 7,500. In the pool of funds, their amounts have almost tripled to 22,000 moving forward. And as you can see, it slowly goes down, but for the next few years, it's 22,886. Now, straight line method, same concept, but where you saw one big number here where I had before, you have them per category. So here we made an assumption that every category has $10,000 specifically to that account because that 10,000 sitting in painting cannot be used in roofing, and what's sitting in roofing cannot be used in paving. So that money has to stay there. That's what makes it the straight line restricted method. But here's how the math works here. I can't pool the funds. I have to only use what's here in the roofing. And if there's a deficit, which there is, in year 6, I have to take that $72,000 and divide it equally into the preceding years. Same thing with painting. I didn't do the math on it. I just wanted to give you a concept of how these reserve studies are created when it comes to the two different methods. So here in the roofing, you see that you have a deficit. Painting, you have it in year 2 actually, and it will get separated twice, so that number will be divided just to keep it above a positive balance. And then in paving, it happened twice. So we had to add 5,000 here, 37, and we're gonna put those blue numbers and do the math on it. We just didn't do it here. This is for example purposes anyways. Now, well, actually I did do it. There it is. So you can see the fully funding number is that here for the paving. Now, the straight line method, they're collecting $7,500. Remember in the pool of funds, it was about $22,000. That number here is $34,000. So you can see it's considerably higher versus the pool of funds method. Now, of course, it ends up going down over a period of time, but this is how the math is actually done. People have always wondered, how can it be possible? Numbers can't just get lowered. Yes, it can. It's how you do the accounting on it. So there's a big difference if you notice from the pool of funds, once again, at 22,000, but on the straight line method, it's 34,000. There's almost a difference of $12,000 or more. And it's a big difference if you're only collecting $7,500 as to how much more your reserves are going to increase every year. Okay. I believe that's it. Well, here are the two basic, here, I'm going to make it a little bit bigger. I think it's really important to see. You can see the difference between the two methods. Look at that. And look at that. Big difference. Okay. Thank you very much. Peggy, Daniel, I think I'm done with my presentation. And if anybody has any questions, would love to try to answer it for them.
All right. Well, thank you, Sundeep. We have quite a few questions, 20 in fact, so it's time for 20 questions. I'll just start from the top. We'll go through them one by one. There may be some duplicates, and I'm usually people will pop in and throw some more questions in while we're doing this at the same time. Can the amortized deficit portion of the fully funded reserve contribution be a special assessment? If your option is that your SIRS states for reserve deficit funding are a one-time special assessment or adding the amortized deficit amount to the normal annual contribution, must your SIRS state the manner in which the association is going to fund reserve deficits, loan, special assessments, etc.?
Okay. Now that's a really, really good question, and I've been dealing with a lot of that. The whole purpose of reserving is to be properly funded. Now, I would still recommend speaking with your attorney about this. But if you're achieving the same goal, which you are, so for example, so I'll give you an example. I have an association that has a big project coming up in 3 years. And that is literally adding almost $1 million more in deficit funding over a period of 3 years. So what they're going to do, or they're planning to do, is, by the way, even the special assessment must be approved by a majority vote of the membership, but it must be approved now. So you can approve the deficit amount today through this board, then you can take that out. You should still disclose it, and your fully funding number will only become your normal annual contribution. So you can special assess, but that special assessment must get approved now for the following budget year. So if you had deficits of, let's say, $1 million extra called deficit funding for the next 3 years, every year, you potentially could vote for a 3 year special assessment approved by the membership and take it out of your reserve calculations. And then your normal annual contribution is what is now going to be your fully funding number. But I would still disclose it. I would disclose it on my reserve schedule so everybody understands that that's money that's being special assessed is going into their reserve account. And I think it's also a good idea from a perspective of potential buyers that are coming in. They are going to look at, oh, okay, this is really my real cost. This special assessment here is only temporarily. So these are some of the reasons why associations are considering a special assessment for that deficit amount. And yes, I've had a couple of associations where they've taken, and it wasn't really that much, but it was still about $300,000-$400,000 over a span of, I don't know, 12, 15 years, and they just special assessed it, dropped it in their bank today. So the deficit disappeared. All they were working with now is the normal annual contribution, which was much more manageable. Keep in mind, again, the deficit funding, even though you're seeing it in the future, it's from the past. So you're really making your past right today, which is really the right way of doing it. But the state's allowing that flexibility because people can't afford that special assessment. So the state's saying, well, no, that's fine. You can take that deficit out into the future, which is what's literally happening.
Okay, thank you, Sundeep. Thank you, Suzanne, for the question. Next is Carol. Is it necessary to give members the option to vote for lesser or no reserve on an annual basis?
Okay. I think I understood that question. So if the board feels my reserve study states whatever, $80,000 for the non-SERS, for example, or if you're an HOA or two-story condominium, and the board feels no, we need to do this. You do not need a vote for that. You only need a vote if you're going to do less than what the reserve study states. Then you need to go out and get a majority vote of the membership. But it's up to the board. The board does not need a vote to do the right thing. It's only if they want to do less than whatever that number is, then they need a vote.
Okay, next question from Nancy. Can the owners petition the board to pause the structural reserves if the board prepared a budget to not, I guess they prepared a budget because of legal guidelines told the board the conditions to pause the reserves does not apply to the association, the structural job is done. All costs assessed for final milestone pass and reserves filed with the state. So it seems like they did everything they needed to do. Can they now pause their the funding for structural reserves?
Yeah, I hope I understand that question properly. So one thing I would highly recommend is you definitely any kind of pausing. Well, I'm not going to say any kind. More specifically for the SIRS report, please, please, please speak with your attorney. Please don't listen to what I'm saying. I'll give you my best guidance as I can, but just get clarification. There still seems to be difference of opinions out there, but Yeah, the state has said that if there are repairs that are going to be done, and which makes sense, because there's large special assessments when there are major concrete restoration project. So the state has now allowed that flexibility. Well, hey, if you're going to be special assessing $1, $2, $3 million, we're going to allow you the flexibility to pause the funding of your reserves. But it's still the majority vote of the membership. Now, the board doesn't need the approval from the membership to fully fund their SIRS report. So even though they may have the legal right to pause their reserves, the board doesn't have to offer it to the membership.
Okay.
Because remember, the membership elected the board to make these decisions on their behalf.
Yep. Peggy, just real quick, Nancy's also looking for a contact in Brevard County for plumbing services. So if you want to touch base on condo vendors. Next question from Dennis. Would fire protection equipment upgrades or repairs driven by a 5-year inspection be an operating or reserve expense?
Okay, one more time. For the paying of that inspection?
No, I guess it's asking for the upgrades. Would fire protection equipment upgrades or repairs? They must have done a 5-year inspection report, found that the fire protection equipment was in disrepair or needed repairs or possibly even needs to be replaced. And Dennis is asking, would that go into an operating expense or could that be a reserve expense?
Okay, so here's how I'm going to answer this. It's really a reserve expense, and especially if you're on the SIRS report. That's now if there's a major difference. So, for example, let's say your reserve study stated $80,000, but the real cost is $134,000. You should do one of two things. One is maybe special assess the difference because you are taking more money out of your reserves than you might have budgeted, and or just get a reserve study update to redo those numbers. But that is the whole purpose of the structural integrity reserve study, is to protect and safeguard your building. So if you do have these repairs that have come up due to an inspection, then I would recommend that, yeah, you can absolutely take money out of your SIRS side. Now, if you have a traditional side, as long as you have a line item for fire protection systems, then you can go into your non-SIRS reserve study as well for your 2-story buildings.
Okay, next question. We are a self-managed single-family home villa community. Our 2022 reserve study had a 3% inflation rate and a 1.3% return on the fund's investments. For the past years, we've had considerable better return on investment, I guess, from what they've done in the past. Can the condominium association benefit from this windfall by lowering the operating budget increase to allocate to the repairs and maintenance of the RF components?
That's a good question, and I'm not sure if I'm going to be able to answer that correctly. I do know that the interest that's earned on the reserve side really needs to stay on the reserve side and not to be used for your operating side. Now, what you could do, let's say, for example, your annual contribution or your fully funding number for your reserves is 100,000, and then you earn 20,000 in interest. What you could do the following budget year is reduce that 100,000 by the 20,000 you just earned, but you're going to now put that as a form of contribution, zero out that interest line, and you can reduce that 100,000 down to $80,000. So you can apply it that way, but I wouldn't take it over to the operating side.
Okay, another question from Dennis. If your association waived collecting reserves in 2025, are you required to have a new SIRS study done in 2026?
Yes, you are. That's what I've been told by every attorney.
Perfect. If we just changed to pooled reserves, can we move the old reserve total on hand over to the pooled?
Okay, so if you're one more time, Daniel, sorry about
I
that.
guess they changed their way of dealing with their reserves. They just moved to pooled reserves.
Yeah.
And they're looking at the old reserve total and they want to know, can they just transfer that over to now call it pooled?
Right. So, that's another really good question that I, as a reserve specialist and a PRA, is really struggling with. I'll tell you what the prior law was. The board only needed the board could vote going from straight line method to the pool of funds method. They didn't need a membership vote. They could do that on their own, except the existing monies that were in the accounts must stay there because you're not getting a membership vote. You're only getting a board vote. So if you had money set aside for your swimming pool, 50,000, your roof for 100,000, elevators, if you had those allocated and you take a board vote, you can switch over, no problem. You just got to keep the old money there. That's it. Going forward, you're going to go everything into a pool. If you got a membership vote, now you can start playing with the money and putting it all into one big pocket. That was the old rules. That was always applied. The state of Florida now came out this year that stated the board no longer needs a vote of their membership. That's what the state of Florida says in order to switch from the pool of funds to the straight line or the straight line to the pool of funds. Unfortunately, they don't know, enough about reserves to have clarified that even further. So I would say speak with your attorney because most likely the consensus might be that you still have to keep your old money where it is. But the law has not clarified that for us. So they put it on the laws, but that was always the case before.
Gotcha. Okay. Well, that's pretty interesting.
That makes sense.
Yeah. Next question. Can a condo association have pooled reserves outside of SERS?
Yes, but so you're going to have your SERS stuff, but your most condominiums are still going to have non-SERS. You're going to have an elevator, you're going to have paving, you're going to have your interiors, light poles, whatever, and you can absolutely pool those funds within all those specific categories.
Okay. Next question. Since reserve studies only focus on what can be seen to evaluate for RUL conditions, what about the subterranean systems, such as pipelines, that we are responsible for? We also have stormwater ponds that are green and a concern.
Sure. I would say speak with whoever your reserve provider is. My own experience is that I do try to communicate this with my board members or the property manager, and we do include things like that in the reserve study. And you're right, we have to be able to see it. But the fact of the matter is, we can't see plumbing pipes behind the wall either, but now the law says you have to put plumbing in there. So yes, and by the way, there are costs to that because if you've been in the business long enough, you'll see the range of that cost of replacing these pipes. But what I would probably do before ordering a reserve study is get a professional, plumbing company to somewhat analyze it to some extent and a potential cost along, whether it's plumbing or even electrical wiring or underground. Stormwater is a great example also. They can put cameras down there. But definitely try to find out before you order the reserve study so you can communicate that information with your reserve provider. Because the cost they may be able to help you with to some extent, but if you come up with it, hey, great, because now you have something more realistic in there. It's just the remaining life is usually a struggle. Some things last quite long. And by the way, concrete doesn't all last the same. It appears to people that concrete all last. No, they have different timescales, how they make concrete.
Absolutely. Okay.
But you should include them in reserves, in my opinion. Sorry.
That's okay. Larry asks for clarification. So if they're using the straight line method, are you still able to shift funds but require a vote? And if so, is this vote majority or unanimous?
Oh, okay. Well, it's a majority vote. So let me go backwards with that. It's a majority vote, and the majority vote, in my opinion, is 50% plus one. That's just my definition. I think most people have agreed with it, but you definitely want to check your condo docs because I heard one board member say, no, our condo docs say 75% is their majority.
Well,
But she's
Sundeep, I
usually
think, I'm sorry to interrupt you. I think the question is for clarification. If they're using an itemized straight line method, can they move funds from one line item to another? And then, if so, does it require a vote?
Yes, it does. Yes, you can move them, right? But remember, SIRS has to stay on the SIRS. So if you're using the straight line method on your SIRS, that you can play around here with. Uh, and then here you can play around with your non-SIRS, like your swimming pool elevators and what have you. You just can't cross them over. So long as you get a majority vote of the membership, you can definitely do that within each of the individual reports. Now, if you have one, you can absolutely do it there. You just need a majority vote of the membership. Um, That's the only word that I've heard is majority vote.
Okay. Just to be mindful of time, Peg, it's 11:30. I'm happy to continue with questions with Sundeep, or if I don't know if you want to wind down and have we still have 20 questions, so all the questions we're asking, we're getting more into the box. Do you want us to continue, Peggy, or did you want to wrap and have Sundeep answer these separately?
Well, I hate to say cut it, so why don't we just say, Sundeep, can you stay and answer more questions, or?
Sure, sure.
Okay,
Okay.
well,
Well,
let's continue if
yeah,
you
let's
can
give it a few
also,
more minutes.
Daniel, and let's
Okay.
cut it off at quarter till.
Sounds good.
Thank you.
Chris asks, there was a multi-year delay in establishing a reserve fund, and our reserve fund is not funded well enough to replace all the roofs assessed and in need of replacement. In lieu of a special assessment, can we have each member donate the exact amount to the reserve fund as a workaround to the legal costs involved with a special assessment? Well, that's a new question I haven't heard before.
No, I've never heard that. And since I've never heard that terminology ever used, I don't donate. I don't know what that means. Donate. You don't donate money.
It sounds
Um,
like it sounds like a check with your lawyer question.
it's definitely a check with your lawyer question.
Okay.
Sorry.
Next question. What is the difference between painting and waterproofing? Do
Uh,
some costing systems incorporate coating systems incorporate both?
yeah, yeah. Okay, I'll explain that. Painting slash waterproofing. According to the state, they're referencing waterproofing as painting and being called the same thing. The dilemma actually comes with IRS, and this is just because of Mr. Frazer, which is the company that I'm with, explained this to me that IRS didn't like painting to be a reserve item, but the IRS is not saying anything about it and has now for the last 30, 40 years. So when it comes to your structural integrity reserve study, painting, waterproofing, they're referencing really only painting the surfaces. That's what it means. The waterproofing also you can see on your structure restoration side on balcony decks or decks that are above parking garages. So what they do is they take all of the coating off down to the bare concrete on a balcony deck. Then what they do is they lay this polyurethane material down, they seal it. That is what's called waterproofing for concrete related. And then on top of that, they will either concrete texture the deck and then paint, or they'll throw tiles on top of that. So the waterproofing for concrete decks is very different than the painting slash waterproofing they're talking about in the painting section. So in the SIRS, just remember when they talk about waterproofing, it's really related to only the painting of the surfaces, where if you go into your structure restoration section, you may see waterproofing, but it's a different form of waterproofing. It's not painting anymore.
And have you heard of coating systems that incorporate both? I presume so.
I'm sure. I'm sure there are, but
We got to ask one of our painting vendors, Peg. We
Mm.
need one of our painting vendors to give us an answer on that
I
one.
have a class coming from Sherwin-Williams here in a couple weeks, so that'll be a good one.
There we go. Peg, there's a request also for Ruthie's contact info for HVAC vendors, also in the questions. Next question from Nancy. If $20,000 was used from the structural reserves in 2025, does the 2026 structural contribution need to be an additional 20,000?
Read that to me one more time. I'm sorry.
I think what Nancy's asking is, do you need to replenish the structural reserves? So if you had to spend 20,000 in 2025, do you need to add another 20,000 in 2026 to make up for what was used in 2025?
Well, so that amount should have already. So when you get a reserve study, hopefully you're working off of a reserve study, it'll give you the contribution amounts for the next 25, 30 years. So you don't, if you've used 20,000 out of it, it's already accounted for. So you don't really have to. Now, if you spent 20,000 more than you should have, then you may want to do something about that. Now, but you don't need to put the full 20,000 back right away, because if that 20,000 is something that's going to last 10 years, then you probably only need to put aside 1,000 extra for that which you have taken out for the following year.
Okay. Oh wait, I'm sorry. She had a follow-up. It says if the 20,000 was not used in 2025 traditional reserves, can the traditional reserves be funded by 20,000 for the 2026 traditional contribution? I think it's still the same answer as you gave, Sundeep. I think what Sundeep is explaining is that your reserves are essentially spread out over a lengthy period of time, and you don't need to replenish them the very next year. You can replenish them on the timeline that the reserve specialist has laid out. It will, or I should say, it will self-replenish on the timeline the reserve specialist has laid out, because that's the whole purpose of the reserve study, is to determine how much time do you need and how much money do you need to raise from your community to replenish the funds as the life cycle of these parts comes to the end and needs to be replaced. Did I say that correctly?
Yeah, no, you said that quite well. So, as a general blanket question, these reserve study standards are, well, the payment schedule is put out over 25 years, and the remaining life is absolutely going to change. It always does. I mean, even in your own home life, nothing really breaks when it's supposed to. It breaks when you're at least expected. So that's a normal part of reserves. But what I would do is every year just pay attention to your reserve balance. There is a comfort zone. Just try not to go below that comfort zone. Um, that's probably the best advice I can give, but you don't need to be replenishing it or adding extra to it every year. But if the amount is large enough, then do something with it or get a reserve study update through your provider.
Okay, Rebecca's question. What happens if when you had the SIRS report done, you had 9 buildings that were 3 floors or higher, and they were included in that report? Now that the word in
Habitable.
inhabitable
Yeah.
has been added, only 2 of those buildings still require being included. Do we need to pay our engineer to redo the study to reduce the units covered, or can the board determine the change alone?
Okay, that's a great question.
Yeah, that's an interesting one too.
Yeah, it's an interesting question, and it's something that us reserve people don't like, and I don't think every reserve company is seeing eye to eye on this. So I'll give you my 2 cents. I'll tell you what other reserve companies are, how they are also looking at it. So I'll tell you how another reserve company is looking at it. You're one association, you're one big family. Everything that's on your SIRS is extremely important, whether you're 2 stories, 3 stories, or 4 stories. And as a family, you guys should all behave like a family and fund everything. Because if one building goes down in your association, I can assure you all the other ones will be affected. Oh, that's the place that one building fell down on. Now, I'm not saying buildings will fall down, but so my opinion is that you should, but you are not required to legally. So legally, it's 3 habitable stories or taller. So legally, all you need to have is those 3 stories on the SIRS report. Will it bring your contribution down? It will, but it's really just going to transfer it to your non-SIRS, because you still have a non-SIRS. So the roof, painting, if you have fire in the other, they're still going to go over there, except you're going to be able to vote on this. That's the only difference. That's the only difference.
Okay.
Excuse me, just one interjection though. Please, please, I can't stress this enough. Consult your attorney, please.
Thank you.
Can a non, this is from Carlton, I believe. Can a non-SERS borrow from the reserves? If so, what are the constraints? I think the question is basically, can you borrow from SERS versus non-SERS reserves?
I no. I'm going to say consult with your attorney. I know for a fact that you cannot touch your SERS money. So your
Okay.
non-SERS cannot touch your SERS money. I know that for a fact. So you do not go in that direction. Whether you can do it the other way around, I cannot give you an answer on that. No one has really even said it that way. Um, so I would say just consult your attorney whether you can do it the other way around, but definitely you cannot touch your SERS.
Okay. We have 5 more minutes. Next question. Our 50-year-old, 5-story, 60-unit condo recently finished a complete building inspection, concrete restoration, and full painting at a cost of about $500,000. What would you suggest putting in a reserve study 10 years out to perform another inspection and quickly address any issues that might come up over the next 10 years? That's kind of a loaded question.
It is. It is. Oof. So remember one thing, even though the SERS by law is required only to be updated once every 10 years, the analysis that's supposed to be given to the association has to span out over a minimum of 25 years. That's the law. So when you get a reserve study, it's going to span it out over 25 years. Now, depending on the extent of the work, what it depends on what kind of reserve provider you have. We're not into putting the full whatever, 5, 10, 12 million dollars into reserves at a certain span of time. We're more into putting more monies aside more often, like every 5 years. Or every 10 years, before you paint your building, you want to have it inspected by an engineer and not just cover up those cracks. It may cost you an extra $30,000, $40,000, but it's going to save you, hopefully, from a major concrete restoration project. So it may not be all of that. Let's say you spend $500,000 that we're going to throw another 500,000 10 years later, maybe spread out over a longer period of time. But we're going to put it where you now have the money to do the work properly versus getting a maintenance guy up the road to patch something up.
Okay, and I think you just answered this next question at the same time, which is how many years should a SERS go out? I think you said 25.
Yes.
Perfect. Francis wants me to tell you did a great job, Sundeep.
Oh, thank you. Thank you, Francis.
Marlene, we have a question regarding electrical. Can we speak offline? Okay, yes. Marlene would like to speak to you offline, Sundeep. Her information is in the question and answer. Ray, I thought the special assessments were a board of directors approval, not a membership vote. Does it matter if it's operating versus reserve?
I would say speak with your attorney on that. First of all, the board has to approve it. But I can only talk from a condominium perspective that they still need to get a membership vote. But your condo docs might say something differently. But a lot of the associations that I've been dealing with, they've been going out there to get a membership vote, especially if it's affecting the SERS report. So it may be a different scenario that, hey, we had an underground pipe that just broke and we need $100,000 to go out and special assess of someone versus you are now dealing with a structural integrity reserve study and you're trying to do something else out of it. There is where the membership vote is what I'm seeing what everybody else is doing. So the board can approve that vote, but they have to get a membership vote out of it.
John also, thank you to Sundeep. Great seminar. Peggy, people are asking if you can please make sure that Sundeep's info is included when you send out the information. They'd like to be in touch with him. Next question. How do you define and separate the elements involved? This is from Angela. How do you define and separate the elements involved in roofing and painting capital improvement projects such as fascia, soffit repairs, building columns, wood repairs, exterior foyer, ceiling repairs? So the bigger question, how do you separate those elements?
Yeah. So just remember something. We're not going to always get everything in a reserve study, or that thing would be as thick as a book. And reserve specialists are not required to do so because it's really not even possible. But most times within the roof replacement, we do have cost put aside for the common damage that may occur to the subsurface of that roofing system, for example, and soffits being included. So I can only speak to you from my perspective that we ourselves don't have a line item just for soffits. We do have a line item called roofing repairs and miscellaneous. We want to keep them broad. Surprise, right? Surprise. Yeah, we never knew this thing existed underneath your roof, and now we have to deal with it. So we don't go into we go into a lot of detail, believe it or not. It just depends on what kind of reserve study you have. But you may not have everything broken down. But remember, it's a part of your structure. It's a part of your system. So you can go into reserves to take that money out. But if you find, and this has happened, where a roof that was supposed to have cost maybe 550,000 plus or minus costed $1 million because they waited 40 years and the subsurface had to be completely rebuilt. When that happens, you're going to have to special assess because that money is not going to be in reserves.
All right, we'll do two more questions, Sundeep, and then wrap it up.
Okay.
In your opinion, which is better, pooled or straight line?
Okay. It's an opinion. I like the pool of funds method because it provides a lower contribution amount, which is going to help people stay in their units because the straight line, with the way things are going, is going to become unaffordable. Secondly, I used to manage 3 different hotels at 3 different times franchise, and when I would ask for the money and the money wasn't there because the owner said, nope, patch it. Well, he wouldn't even say patch it. I would patch it and it would break again a year and a half later. It was still my fault. So board members, when they're short 30, 40, $50,000, but you need to do the project correctly, the pool of funds really helps versus going out there and saying, do you think everybody will like that we're going to fix it properly? But they don't even understand how construction. So that's why my preference is to the pool of funds. I like having the flexibility. My experience from my end, I can tell you, I wish board members would spend more of their money because some things I'm looking at you should be spending the money. It's not the other way around that they're spending money foolishly, unless they're putting a $20,000 repair job to something that's already past their useful life.
Yeah, I think that makes a lot of sense. Okay, final question, and this one's actually interesting to me as well because it's asking about insurance. MC wants to know why can't there be a reserve or reserve for the possible insurance deductibles? Is there any law that disallows you to put in reserve for your insurance deductibles, or for that matter, premiums? It could be a huge amount. That's interesting. I never had anyone ask whether or not you could build up a reserve for either the deductibles or for the annual premium, for that matter.
Yeah. And that's a really good question. And the answer is no, you cannot have that in reserves. I agree. That's a really smart thing to do, especially if you have $250,000 to a $500,000 deductible to have something. Imagine asking every unit owner after their building's been destroyed, hey, I need money for you, by the way. But you cannot have it in reserves.
That's
I
a
would
great
say
idea,
probably,
though. Someone
uh-huh.
should take that to Tallahassee, MC. That's a really good idea because it would be a smart way for the community to set aside the money necessary and not get hit by a massive surprise number because they don't even know what the deductible. The community itself doesn't even know what the deductible is. They're only going to find out when, God forbid, a disaster strikes, and then all of a sudden everyone's got to come up with all this money. So that's a really, really good question. I wish somebody would take that to Tallahassee.
I
Okay,
agree.
with
Now
that,
the only quick thing I'm going to add there, and I'm okay with my time, is that I've heard people getting lines of credits, but banks don't like to do that because it's tying up their money. But a line of credit is probably the only other option that I've heard of for a
Or
deductible.
pooled, if they had pooled, they could use some of the money if they had to, right?
No, 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 not for deductibles, not for
Okay.
insurance. Now, of course, if you take that money and fix a portion of your roof because it got damaged, that you can absolutely do. That you can
Yeah.
absolutely do.
yeah. All right, Sundeep, thank you very much. That was an incredibly informative class. I think a lot of people got benefit out of it. A lot of people stayed on for our question and answer, so they really appreciate the way you approach this and your explanation. Thank you all for joining us. I'll turn it back over to Peggy.
Okay, great. Yeah, ditto to that comment. And thank you also, and Daniel as well. Thank you to sponsors, CAMs and boards again for joining us. I do know you have choices for webinars, and I'm glad you're choosing us. I do want to mention a few classes that are coming up on 11/21, which is next Friday. I have Clarkson and Varick elevator consultants presenting Understanding and the Modernization of Elevators. This is a hot topic for condos. So this is not an elevator installer. This is a consulting firm, which I recommend to use consultants for every major project besides your engineers. December 9th is a class coming up by Sherwin-Williams. Someone was asking about painting. I already had Benjamin Moore in. Now I've got Sherwin-Williams coming. That's a 12 to 1:30 class, December the 9th. And December 16th, this is the last class of the year for me. From 9 until 12, we have the 2025 Legal Update class, which is going to be put on by Rosenbaum PLLC. We have Steve Brayton presenting, and this is a required board class to get your certification completed for 2025. So there will be other classes in the new year for board certifications for 2025, but this is my last one for the year. With that, I just want to mention Sundeep is allowing me to send out the slides for this presentation. I will send it out along with these sponsor sheets, which will have his information and all the sponsors' information on it. Also, I will be sending out the recording. I want to say to all of you, have a happy holiday season. I know it's early. Thanksgiving is a time of giving. I hope you find joy in being grateful. And if you can give in somehow or some way, it will be appreciated. God bless you all. I wish you many blessings, and don't eat too much pumpkin pie.
Thanks,
That's it.
Peggy.
Thank you,
Have a
everyone.
good one, everybody.
Yeah.